Hello, everyone. Welcome to your final market update for 2025. My name is Miguel Rodriguez. I'll be going over our market update for this evening, and I am very excited to talk to you today via Facebook, YouTube, and other channels that we have playing live right now from our headquarters here in South Miami. We have a lot to cover. I have a lot of nice information to share with you guys about expectations, what is it that we see in next year, and what type of risk are heading our way and possible solutions how to navigate this volatile market that we're seeing nowadays. I'm actually very excited for this because we've been through a lot this year. We had lots of ups and downs going back to April, tariffs, middle of the year. Now at the ending of the year, we had the shutdown. We have interest rates today, and we have a lot of information to go over throughout today's webinar. And again, my name is Miguel Rodriguez. I'll be your host for tonight. And let me go ahead and get started. I'll be sharing my screen. We'll be together for roughly around 45 minutes. And I hope you guys are taking notes because we will be going very fast over these topics. And there's a lot of information. If you guys have any questions, drop it down in the chat below. I'll try to look at them as much as possible and address them throughout the webinar. But again, I'm Miguel Rodriguez. I'm one of the senior wealth advisors here in Guerra. I have a master's in finance and I'm a retirement income certified professional. And I've been with Guerra for the last 5, 6 years. It feels like 20. It's a good thing. I serve many different families, and I am very blessed to be in this position today. And it's a great company. We're a family here. But, anyways, enough about me. You guys know a lot about me. And for the families that don't know us, Guerra Wealth Advisors, we use a custodian called Fidelity Investments. That's where we park our clients' money. We manage between $800 million to $1 billion across different investment vehicles. Now, in Guerra, we go through a very specific planning process for the families that we serve. Today, we're going to be talking about investments, but we do way more than that. And this is good for the families that we don't serve, for you guys to know all these different details. Now, in Guerra, we go through a three-phase planning process. Now, phase one for the new families that we serve, we go through a phase called the discovery phase, where we have a couple meetings. We'll talk about you, your goals, what challenges are you facing, and what possible solutions can we implement to optimize the financial plan that you have for yourself right now. Now, phase two, that's when we get to work. A nerd like myself starts putting all the pieces together and structuring your financial plan across the 5 main financial planning areas, which they are retirement planning, meaning creating a withdrawal strategy out of your portfolios to sustain yourself throughout retirement, making sure that we map out a spending plan that includes your lifestyle, your dreams, and your goals. That if you might want to spend every single year $20,000 in vacation, that we have that mapped out to make sure your money lasts for the rest of your life. And if your goal is as well to leave a legacy, that we get that taken care of. Now, area number 2, which is today, investment management. This is one of my favorite areas because we get to talk about what is going on in the markets. And for the families that we serve, we optimize their portfolios in a way that we're getting more reward for the amount of risk that they're taking. There's many different investment vehicles that have different outcomes. The best investment vehicle does not exist. There might be different vehicles that help you get to that target and goal of yours, but we have to make sure that we tailor everything around your financial plan. Now, area number 3 is tax planning. How can we save more money in taxes? Keep more in your pockets so we could reinvest it back into the portfolio. Not sharing your accounts with the IRS. There's many tools and strategies that we could implement to help you save money in taxes. I just met with a family the other day. They're planning on selling some real estate properties, and we're creating different strategies how to save that massive tax bill that's coming their way. How can we minimize that tax bill? And I'm very excited to share the solutions with them over the next couple of weeks. Number 4 and number 5 is asset protection and estate planning, making sure, God forbid, there's a lawsuits or medical expenses, your wealth is not wiped out by these emergencies. And lastly, estate planning, having all your legal documents in place to transfer all of your wealth to the next generation with the right stipulations, restrictions, and contingencies. Having the right people in place to make decisions with your money and your life. Very important. It's a massive topic that people do not talk about enough. Phase 3, that's when all the pieces of the plan are implemented. Well, now, enough about this. Let's get started. Now, what is the agenda for today? So today we'll talk about market performance, what has happened with the market over the last month, what are the main drivers and the trends that we are seeing in the economy right now, what's happening with inflation, interest rates, and indicators that we're seeing, and lastly, opportunities and risk. What's happening? What different things can we use, or what should you be looking at in your financial plan and your portfolio to take advantage of opportunities as they head your way? Now, let's look at the stock markets for this year. For this year, there's different indicators and benchmarks that we mainly look at. Think about the S&P 500, the NASDAQ, and the Dow Jones. The S&P 500, for the families that do not know what that is the largest 500 companies in the United States. The S&P 500 for the year, as of today, is up 17%. That's amazing. The stock market this year, disregarding all the massive headlines and all the weird headlines that we have seen throughout the year, is done very good. Now, the NASDAQ itself, the NASDAQ is the largest 100 tech companies in the US, is done for the year 22%. And the Dow Jones is up almost 13%. That's counting the drop that we saw through the tariffs. And even after that, we saw a very nice rally. And over the last month, with the shutdown and earnings, we saw a little drop, but the market has recovered very nicely over the last couple of weeks. Now, a couple of things. Let's zoom out a little bit. Let's look at the stock market over the last year. The S&P 500, again, is up 14% over the last year. The NASDAQ, strictly tech, is up 20%, and the Dow Jones is lagging behind at 8.61%. When you look at the S&P 500, again, some people might be thinking, Miguel, I like that middle one. I like the NASDAQ. Let me put all the money there. That's just strictly tech. You're kind of putting all the eggs in one single basket. When you look at the S&P 500, part of the reason why it's lagging behind compared to the NASDAQ is because of the risk is more spread out. There's different sectors that are inside of the S&P 500, not only tech. Now, this is very good to see, guys. When you see the drop here through tariffs and the nice rally that we saw, and after elections as well, we saw the volatility. In January, market went up a little bit, and all the fiscal policy that was getting implemented due to the new administration affected the market in a way because that spooked the market, and the market went down, and then after, the market went up nicely. Now, a couple of things. Let's zoom out even further. Over the last 5 years, the S&P 500 itself is up 88%. It has done very good over the last 5 years. Look at the NASDAQ. It's up 108% basically. And then lagging behind again is a Dow Jones at 60% when we round it up. Now, lots of things have happened over the last 5 years. We had COVID. We had inflation as high as 9%. That's what we see, this drop that we see here in 2022. We had the Fed that had to raise interest rates back in 2022 to battle the high inflation. And also in this specific year, we saw midterm elections, where we will talk about that later on once again. But look at this nice rally that we saw. And then the drop behind the tariffs and the nice rally we saw right after that as well. We've been spoiled, guys. Since 2023, the market has done very good. And we're at all-time highs right now. The market, as of closing today, it reached again $6,900, 6,900 points, which is very good. Now, let's look at the sectors that are inside of the S&P 500 and how they have done for the year. So again, the S&P 500, that is the benchmark of the economy of the United States. There's many different sectors that we track inside of the S&P 500, such as communications, information, industrials, utility companies, financials, healthcare, energy, consumer discretionary, materials, consumer staples, and real estate. Now, when people think, Miguel, what is consumer discretionary? That's the sector that tracks the companies of what the consumer spends money out of wants, not necessities. Those are companies that are not necessities for the consumer. The necessities for the consumer, that's consumer staples. Those are necessities. Those are most likely things that they need to survive. Think about food. Think about bills. Think about waste management. Those are consumer staple companies. Now, if you see for this year, what has been the best performing sector, no doubt about it, has been tech. Tech year to date is up 32%, when you look at the communication sector, and 26% when you look at the information sector. Tech has killed it. There's a lot of innovation that has been implemented that the market likes that. The massive institutions, they're betting a lot of money on all this artificial intelligence, optimizing their daily operations and their business models. So it's a massive bet that's going on right now with artificial intelligence. But now, we still have to be cautious. When you look at the market right now, there's a lot of risk still in the market. We're looking at tariffs, we're looking at a lot of softness, a lot of weakness in the labor market, and then we see inflation being a little bit sticky. Now, the market is very concentrated. We'll talk about that later on as well. And then again, rates going down today is a good sign because we need rates to go down to help the job markets. And next year, with the conversations that the Fed had today, they have mixed feelings on what's going to happen with interest rates. But we'll talk about that later on as well. Now, again, guys, if you guys have any questions, drop them down in the chat below. I'll be addressing those. Let's look at over the last 3 months, the best performing sector. Once again, technology. Then we have after that healthcare. And then we have after that communications. Healthcare is what is called a defensive sector. It doesn't really matter what's happening in the economy, recession or whatnot. That's a sector that historically is always making profits. They have good earnings and it's a very stable sector throughout history, except over the last year or so with the issues that we saw with United Health, that there was a lot of scares behind that sector. Now, let's look at the stock market today. So this visual right here is very good. I'm a massive fan of this visual. Right now, we are in what is called a bull market. So a bull market is when the market keeps going up and up and up. Historically, a bull market lasts on average around 74 months. In today's bull market that started back in September of 2022 has lasted so far roughly around 37 months. So technically, if the bull market was to continue, on average, if history was to repeat itself, we're halfway there. Now, Miguel, great. You're telling me how long does the bull market last, but what does it mean to the market? What are the returns on my money when it comes down to that? Well, historically, a bull market, the total return of a bull market is 343%. When we look at today's bull market that we've seen, how the market has done is up right now 100%. So the average returns of stocks of a bull market, we're not even halfway there. And there's a lot of things that are happening in the economy that could boost this up, or it could make it more choppy, and we could see some choppiness in the ocean coming up next year. Now, we're not saying that the market will only keep going up. There's a lot of things that we'll address today and concerns that we have. And the goal of today's conversation is to create some awareness, and this could help you make some decisions and you self-reflect on how you have things structured right now when it comes down to your investment philosophy. Now, let's look at a couple of things. I have had a lot of families over the last couple of months and mostly this year talk to me about artificial intelligence and a bubble. So we did a lot of research and we gathered a lot of information to see what happened back in the dot-com bubble when it came down to those companies and how can we relate that to today to compare apples with apples. When you go back to the tech bubble that we saw back then, from June of 1996 to the early 2000s, earnings of those companies went up 79%. But the stock prices of those companies on total went up 479%. Earnings were not keeping up with the returns of the stock prices. The earnings went up a little bit and the stock prices skyrocketed. So that's a massive reason why we had a dot-com bubble. Earnings were not keeping up. Fantastic, Miguel. How does it relate today? How does it look? How do we compare that to what we're seeing today with these massive companies that they're betting a lot of money on artificial intelligence? Let's look at it. From September of 2021 to 2025, earnings of these companies of today has gone up 77%, and the stock prices has increased over the last basically 4 years, 121%. So earnings have mostly kept up with the appreciation of the stock prices. So if we were to say we're in a bubble, we're not even halfway there because the earnings of these companies are pretty good and the stock prices are not reflecting a massive bubble right now. May something happen out of the sudden? Absolutely. But now I want to show you a couple other data points let's shrink the data that we have right now. Let's look at over the last 3 years how earnings have kept up with the appreciations of the stock prices. And now this could open your eyes a little bit further. Now, for the tech bubble that we saw back then, from 1997 to the early 2000s, earnings went up 53%, but the stock prices went up 360%. That's concerning. The returns went up 7x compared to the earnings. When we look at today, from 2022 to 2025, earnings have gone up 65%, and the returns of these companies have gone up 176%. Okay? It's kind of 3x. So we're not, again, we're maybe halfway there. Now let's shrink it even further. Let's look at over the last year. So earnings over the last year have gone up 21%, and the returns of the stocks has gone up 28%. If we were to say that the history was to repeat itself, we're in like the second to third, maybe the fourth inning of a bubble right now. We're not there yet for the bubble to burst in a way. Hopefully it does not happen. Obviously, we do not want that to happen, but we are taking action in our client's portfolio to spread out the risk across different sectors that take advantage of artificial intelligence without directly investing into artificial intelligence. There's a lot of innovation out there that's great for the stock market, but we need to see more profits. That is the purpose of this visual. We would like to see more profits, and we would like the profits to keep up further with the appreciation of the stocks. Now, let's look at a nice visual. So I met with a family around 18 months ago, and it hurts me to talk about this. But there was this one family that I met with that they've been sitting on cash, timing the market going back to 2017. They keep calling a market crash going back to 2017 because they kept seeing headlines and headlines and scaries and scaries and scaries, and they missed out on massive opportunities trying to time the markets. And it goes back to that saying, time in the market beats timing in the market, timing the markets. It's so simple, but people make it more complicated than it needs to be. And if we look at all the headlines that we've seen going back to 1989, there's been a massive amount of headlines, and there's always going to be a scary thing going on. You have to make sure that your investment strategy correlates with the amount of risk that you're willing to take. And with that risk that you're willing to take, you're getting the right amount of reward behind that. You get the most reward with what you're risking in that sense. But let's look at this. If you guys remember, back in, let's call it 1997, we saw a collapse, Russian financial crisis. We saw 9/11, dot-com bubble. We just spoke about that. The U.S. housing bubble peak, the Lehman Brothers, the bankruptcy. We saw the 2010 flash crash, Ebola. You guys remember that? Ebola? That was a while ago. Time flies. Time literally flies. Look at the China stock market crash, tariffs. The first tantrum that we saw back in 2018. We went through the same, not the same thing, not to the level that we're seeing it right now, but we went through a period of time that a lot of the fiscal policies that we're seeing today, they were getting implemented back in that period of time as well. And history repeated itself. The market went down back in 2018 and then it bounced back. Right now we saw the same thing, but not at the level, and we have not seen the full outcome of tariffs, which we are to see, and we're looking on a daily basis to see how is that affecting the prices of the items for the consumer. Now, you guys remember Russia invading Ukraine? I met with so many different families back then, back in 2020, I believe it was 2022, that they were scared about this. And last year, October 7, Israel and Gaza, the war beginning back then, it was a scary time as well. Look at US inflation spiking to the highest, going back to 1981, as high as 9%. And then we saw here, tariff tantrum number 2. So going back to it, there is always going to be something going on. You have to make sure that you do an analysis, you do an exam on the amount of risk that you're willing to take. The families that we serve, we put them through literally an exam to see how they score on that exam. And that exam gives you a score of how much risk you could take. And we correlate that with their portfolios to see if they're actually getting the right returns with the amount of risk that they're taking. And the risk score of their portfolio correlates with the amount of risk that you're willing to take. And we've seen amazing results behind doing that. Because a lot of people, their portfolios, when they come to us, They were taking massive amount of risk and they didn't even know it. Or they were taking too little risk and the risk tolerance was up here. So that exam is great. If you're one of our clients and you want to retake that exam at the end of today's webinar, you could scan the QR code, we'll book a session, you could retake the exam. And if you're not one of our families that we serve, you could scan that QR code and we could go through that exam. Now, let's talk about interest rates. Now, when it comes down to interest rates and today, what was happening, give me 1 second. I'm looking at one of the questions here. And yep, I see a couple of the questions here. What about investing in gold, hedge against risk and equities? That's a very good question. When it comes down to gold, we met with many different families, and gold could be a strategy. Gold could be something that you use to hedge and implement as part of your portfolio. But now that's definitely a conversation that you need to have with your financial advisor. There's many different families that I serve that we bought gold back at the end of last year in 2024. And the returns of gold for this year have been amazing. May they keep going up every single year. Nobody has a crystal ball. If I had the crystal ball, I love you guys, but I wouldn't be here doing this webinar. I'll be drinking mojitos there in the Bahamas. But yes, gold could be something that you could implement, but talk to your advisor, see if that makes sense. See if you might already have gold in your portfolio. It's definitely a conversation. That's a very good question. And that's one of our clients. Now, what's going on with interest rates? So the likelihood of interest rates going down today was as high as 87%. And the Fed lowered interest rates today. Now, when you look at interest rate itself, what does that benefit the market? Well, for the housing market, it's cheaper to borrow, meaning you could borrow more money at a cheaper cost. You could qualify for a bigger loan for your housing. And then when interest rates go down, retail sales, which again, it's tricky. There's more money in the money supply, but the Fed lower interest rates and the consumer tends to spend more money. So think about it. As a business owner, you could access more capital at a cheaper cost. Business owner gets a massive loan at a very cheap cost. He could hire more employees. Miguel gets that job. He will be spending more money at Richard's store. So there's many different ways when interest rates go down that historically the economy starts doing better. But there's many reasons why the Fed lowers interest rates, which it could be a recession. It could be to stimulate the job market right now. The labor market is not doing so well. Or it could be for expansion, or it could be that inflation went down and it makes sense right now to lower interest rates. Now, we have to be careful going back to inflation. If they lower interest rates too fast, that could cause inflation to go up. If inflation goes up very fast due to the interest rates or the economy or tariffs or whatever it is at that point, the Fed might be forced to increase interest rates. And at that point, that will create a lot of fear in the economy. Now, let me see if I see here any questions that you guys might have. Look at the chat right here. So, yep. So that's a very good question I just saw there in the chat. What happens when the Fed lowers interest rates? Let's look at it right here. I actually have the answer for you. And I think that's one of our clients is Jerry. So Jerry, I have the answer for you. So historically, when the Fed lowers interest rates, there's specific sectors in the economy that get benefited by this. Because a lot of those companies, they leverage a lot of their daily operations. They borrow a lot of money to basically manufacture or create innovation. So when we see here historically, what sectors going back to 1984 get benefited the most when rates go down and there's not a recession? Tech. Tech stocks historically go up, going back to the 1984, 37%. Then we have growth stocks going up 26%, US stocks going up 21%, value companies 16%, and small size companies 15.3%. Now, if they were lowering interest rate for, let's call it, and a recession was going on, different story. Now, I'm not telling you to go strictly and buy tech companies. I'm showing you what historically happens to different sectors and how can you digest this information and make the most, let's call it, the most informed decision for your financial plan. Now, we have, again, a very strategic strategy with our portfolio to take advantage of everything that's going on right now, because we do what is called sector rotation and active management with the portfolios that we manage here in Guerra Wealth. Now, let's talk about the season that we're heading onto. So right now, we're we're going into the strongest season historically, going back to the 1950s on how the market performs. And it's a very good season for the market. That's why they call it the turkey to tax season, which means the market from going back to November to all the way to April 30th. When you look how the market performs, from November 1st to April 30th, on average, it does roughly around 8.7%. When you go back to May 1st to October 31st, the average return of the stock market is 3.7%, going back to the 1950s. Now, what are the best years where the market did the highest returns, and what has been the average from, let's call it mummies to mummies, from May 1st to October 31st? The best average return is 18%, and then the best from turkey to tax is 14%. But on average, we have 8.7%. It's a great season for the markets, but you have to make sure that you have the right mix within your portfolio to take advantage of these opportunities. And next year is a very unique year. And why do I say that? Next year, and when you look at the stock market right now, we are in the most concentrated stock market that we have seen in the history of the United States. Where, again, and I know I showed this last time, but I have to show it once again, 10% of companies are making up for 76% of the value of the S&P 500. Let me say that once again. 10% of companies are making up for 76% of the value of the S&P 500. We are depending, the economy right now, the S&P 500 right now is depending on a few companies to have great earnings to see a nice rally in the stock market. When you look at the equal weighted S&P 500 right now, the returns are not that attractive. And when we see historically, when has been the most concentrated market we have seen in history, the dot-com bubble does not compare to now. Right now it's higher. The Nifty 50 is not even close. And even the Great Depression is not even close. So it's a little bit different. Remember, the concentration that we saw back then, earnings were not keeping up with the price of stocks going up. Right now happens to be, we have these massive institutions such as Google, Microsoft, Facebook, and so on, that they're investing a lot of money in the optimism behind AI, but we have yet to see the reward behind that. But these institutions, they're already established. They already have earnings. We know Google, they have massive earnings. We know Meta, Facebook, they have massive earnings. We know Microsoft, they have massive earnings. They just have a massive bet right now with artificial intelligence. And they're betting that that's going to be the future. Now, what can you do to make sure your portfolio or your financial plan is not only depending on a few companies? Number one, you spread out the risk. Make sure, and when I say spread out the risk, see what percentage do you have in each sector. And what does that mean, in other words, for the returns of your portfolio? Again, you have to spread out the risk. And as I was mentioning earlier, we have a specific strategy that we're taking advantage of artificial intelligence without directly investing into artificial intelligence. There's different sectors that we're using to take advantage of these things. And there's different investment vehicles that we're using for that as well. Now, I'm looking here, guys, at the live chat to see if there's any questions. Couple other things we're talking about possible risk in the economy right now. Next year, we have midterm elections, where historically the market is very volatile. When I say volatile, you're going to see a lot of fluctuations in the portfolios, which is normal. So when we see here, going back since 1970 on the top visual, the volatility, the choppiness in the market spikes from June to November. Miguel, why does that happen? Well, the market does not like the unknown. The market likes to know what's going to happen with fiscal policy. Is fiscal policy going to change? Are Democrats going to change? I'm going to get elected, I'm sorry. And what would that mean for fiscal policy? Same thing that happened back in 2022, the last elections that we saw. Back in 2022, the market went down. But also we had several factors going on at that time, such as high interest rates, battling inflation as high as 9%. And also we just came out of COVID, where they printed a bunch of money into the market to stimulate the market. Now, next year, where a lot of things are going on that could be positive or negative, we have yet to see. No one has a crystal ball. You have to make sure that your portfolio is well structured to battle and navigate this volatility that we're expecting. Now, when we look at this and this visual at the bottom, as you see here, the market is very volatile. Well, historically, after the elections and the market prices in what's likely to happen with the elections, the market tends to go up. And you need to be positioned in a way to take advantage of those opportunities as they head your way. Now, I know I'm going kind of fast. And again, if you have any questions, drop them down below. And I know it's a lot of information, and I meant it to be a lot of information. This is our last webinar for 2025, and I was very excited to share all this information with you guys. Now, what are we expecting for next year? Same concept. Nothing has changed. A lot of volatility in the markets. You need to be positioned in a way that you're taking the right amount of risk that you're willing to take, and you're getting the right amount of reward for that risk that you're taking. Now, next year goes back to the same thing. There's a lot of unknowns when it comes down to the Fed. Right now, with the Fed, they're looking at possible only 1 rate cut to 2 rate cut next year. They're kind of divided right now when it comes down to those policies. Again, when we look at sector rotation right now, there's a lot of rotation that we're seeing in the market and the sectors, and you need to be taking advantage of that. When we look at over the last 8 months, I'm sorry, over the last 3 months, as I was talking earlier, look at the healthcare sector, it's up 8%. It's beating technology. So you need to be positioned in a way that fiscal policy and monetary policy historically tends to benefit different sectors. And that's what we have, what is called active management of the portfolios, and as well sector rotation. Now, when we look at the market as well, again, timing the market is the hardest thing that you could do for your portfolio. And historically, people that do that, statistically speaking, they hurt themselves more than the benefits that they get behind that. So make sure, and again, I have many different families that they think they have the crystal ball, and it does not plan out for themselves. So be careful with that, guys. And it's sad when you see things like that. Myself, because I think about my parents, if they were doing that, that could derail their retirements. That could force them to go back to work. If they bought at the wrong time, or they gambled their money, putting all the eggs in one single basket or one specific stock, is not good. So again, when you look at the portfolio, there's 5 buckets where you could allocate your funds: cash, safe, risky bucket, healthcare planning, and legacy. When you look at the market right now, we're at all-time highs. It is the best time to rebalance your buckets. You do not want to rebalance your buckets, most likely, when the market's at it's the bottom, right? Because you're setting at a loss. So when the market's at all-time highs and you see the risky bucket that has grown too much, it might make sense to lock in some of the gains and reposition in many other different vehicles that you could use at a lower risk. Now, and here's why. I always say this: process beats performance. You need to have a strategy in place, and you need to know, again, your risk tolerance. And taxes has to be one of the main conversations that you're having right now in December. With our clients, we are looking at their portfolios, and we're talking about something that's called tax loss harvesting. Taking advantage of different positions that have not performed for the year for XYZ reason, selling them at a loss to offset some of the gains that they had in many other positions, to minimize the tax liability going into 2026. In other words, lower your tax bill, increase your alpha by doing so. Now, and let me look at the chat right here. So, yep. So again, guys, when it comes down to the planning process that we put the families that we serve, is a very specific planning process. We go through 3 phases. Phase number 1, we get to know you, we get to understand your goals and your priorities, and we have to tailor a financial plan around those areas. Phase number 2 is basically going over the execution. Many different meetings. That's why this process takes between 1 month to 3 months. We will have different sessions about each of the topics. My favorite one, tax planning. I love talking about taxes, mostly with business owners. There's a lot of things that you could do to minimize your tax bill at the end of the year. I met with a dentist about a couple of months ago. We created a tax strategy that year over year was going to save him over $20,000, not factoring his income going up every single year. If his income goes up every single year, the strategy that we implemented will save him even more taxes. And if taxes go up, he will save even more taxes after that. So that makes me very happy. Because by saving $20,000, he could reinvest it back into the business, splurge on himself even more, or even better, reinvest it back into the portfolio to get to the outcome that he's seeking, which is retiring at an early age, which is 55, if I'm not mistaken. Now, phase number 3, that's when we have the team. And then you meet with us on a quarterly basis, on a yearly basis, at least. We talk about tax planning. We review your trust on a yearly basis. And then our clients and families, they get access to all the different events that we do for them. Now, here's something that we show the families that we serve on the second meeting that we have, because we're going to evaluate how you have everything set up right now, just like back in college and high school. We're going to give you a grade. What are the areas of opportunities? We're never going to give you an F unless I don't like you, but I don't like many people. I always like everyone. I'm a nice person. So when you look at the 5 areas of financial planning, we're going to grade you so you could see the areas that you have more urgency on. And we could put the patches on those areas as fast as possible so the boat does not sink. If you're behind retirement, we have a lot to do. If your investments are a C minus to a D, there's a lot to do because, again, you're not getting the right amount of reward with the risk that you're taking. Your investments are lagging, in other words. The opportunity cost behind that, it's huge. You have to get the right amount of reward with the risk that you're taking. How can you calibrate and optimize your portfolios in a way that your money is growing more for you? Tax reduction and estate planning. And then here, we're going to map out and in numbers, in other words, in numbers, we're going to show you the cost of not doing anything. And then here, based on numbers, we'll show you, hey, what is the impact that we could have in your current situation? Now, by doing so, a lot of families might be ready to work with us. If not, we could still be friends. But even if you're not a family that we serve, it's good that you go through the planning session so you could see the areas of opportunity, and then you could take that with you. Hey, if you don't choose Guerra, fantastic. But at least you know what you need to work on, which is great. Now, in Guerra, we have a very big team. We have 65 employees. I'm just the face today talking to you guys about the state of the markets. And it's a big team. What sets us apart compared to all the different companies is our planning process. You will never hear us telling you, hey, park all your money in this specific investment. That does not exist, guys. The best investment is not out there. There's many tools that you could use to get you to a certain outcome that you might want to happen with your financial plan. And the idea is implementing those tools to get you to the outcome that you're seeking. Whoever tells you to park all your money in one single thing, please run away. It does not make sense. Now, if you guys would like to set up a meeting and talk to us about financial planning, if you're one of our clients and you want to review your accounts, scan the QR code below. And if you're not one of the families that we serve and you want to go through those planning sessions, absolutely scan the QR code below and then we'll go over them together. But again, we went over a lot of information, guys. 2026, we're excited for it. There's a lot to talk about. We'll meet again in January and we will be there to talk to you guys through thick and thin, market going up and down. And it happens to be once again that for my webinar, the market went up. So once again, a lot of families make fun of me because of that. Because Miguel, every time you speak, the market goes up. That's not an indicator. I just get lucky, okay? And it happens to be that today I did not do it on purpose. We booked the meeting, the webinar, at a day that the Fed met, and rates went down, and that stimulated the market in a positive way. But guys, it's been a very good year for us here in Guerra. The market did very good. We're very optimistic for next year, and again, we're optimistic because we know the level of planning that we do with the families we serve, and we're intentional with how we position the money and the strategies that we implement. And it's been such a blessed year. It's been such a long year. I got married, and next year, hopefully by the end of next year, I'm talking about kids already. And I'm blessed to be in the position that I am today. I thank God every day basically for putting me in this position. A lot of the clients know my background, and I'm very humble to be in this position and talk to you guys on a monthly basis about the market. But once again, enough about me. Happy holidays. I hope you guys have an amazing ending of the year, and I hope next year is full of blessings for everyone here. And again, if you guys might want to meet with us, book a meeting. If you want one of my clients, reach out to me, reach out to the team, text me, call us so we could book a session before the year ends. And once again, guys, thank you for tuning in for tonight and being with me for the entire year through thick and thin. I look forward to 2026, and a lot of good things are coming our way on a personal level, and hopefully with the state of the market keeps going up and you guys are positioned, if you guys are not families that we serve, in a good way. So enough with me tonight, guys. Have an amazing night and an amazing end of the year.